Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Shridevi Classes YouTube channel where we inculcate interest and confidence in science, engineering and management subjects. Today in our subject project management in topic project financing, we'll learn in this second video about equity financing and we'll see both common stock as well as preferred stock. We will learn about venture capital funding, crowdfunding, and government grants and subsidy. So let's start this second and last video on project financing. Financial estimates and projections are crucial for businesses to plan and make informed decisions about their future. In financial estimates, means of financing refers to the various sources of funding which are available for any business. Now, the appropriate choice of internal or external financing means can have a significant impact on overall financial feasibility of the project. In this learning video, we'll discuss equity financing and we'll touch both common stock as well as preferred stock. Equity financing. We'll also learn about government grants and subsidy, crowdfunding and venture capital programs. We'll discuss advantages, disadvantage of all these fundings. So let's start with equity financing. Equity financing is different from debt financing. Equity financing involves raising funds through public offering of shares or issuing share to private investors. So both general public or specific private investor can buy shares and contribute funds in equity financing. Now the advantage of equity financing is that company doesn't have to repay the funds which are raised by equity financing. This is definitely different from debt financing where we have to repay the principal amount back to the lender. Now the disadvantage of equity financing is that when shares are offered to investors, company also share ownership and control of business with these new investors. When a shareholder as equity investor contribute finance to a company, he also got a say in company operation, especially in difficult times. And major shareholders often entitled to vote to decide critical operational decision of a company. Now companies like to sell equity because the shareholder as investor bear all the risk. If say for example business fails, then in that case investor or shareholder gets nothing. In equity financing, an investor gives their money to a company or business and receive some claim on future earning in return of either appreciation of share prices or regular dividend paid by company or business to shareholders. Common stock is a type of shareholding of equity financing that represent ownership in a corporation and that gives shareholder the right to vote on company matters. Now those common stock shareholder also receive dividends and they share part of company profit. By common stock, companies can sell ownership stake to investor and in return investor provide capital to the company. Unlike debt financing, the common stock doesn't require a repayment of capital invested in a business. At the same time, shareholders do not have a claim on company's asset, and even after issue of common stocks to investors, company can continue to operate independently though it has issued common stock to shareholders. Preferred stock are another format of equity financing, and in fact preferred stock combines the characteristic of both debt financing and equity financing. Preferred stock offer fixed dividend payment to investor and it also involve potential capital appreciation of stocks, but there is no obligation for repayment of principal amount as it is in debt financing. These preferred stockholder investors are entitled to receive dividends before a common stockholder. So they got a preference in dividend payment and dividend rate is typically fixed, and generally it is stated as a certain percentage of stock par values. In difficult condition of business, when profit become limited, any missed dividend of such preferred stockholder will also accumulate, and it must be paid before a common stockholder receive its dividend. Unlike common stock investor who have voting right in company affair, these preferred stockholder won't have any voting right, but they have preference in fixed amount of dividend payments. Some companies also offer convertible preferred stock, and such preferred stock can be converted into common stock if shareholder opts the so. As pros of preferred stock or advantage of preferred stock, we can say preferred stock allows companies to raise capital without diluting the ownership and voting right of existing common stockholders, because these preferred stockholder won't have any voting right or say in company affair. Preferred stock is an attractive option for investor who seek just regular income by certain fixed dividend rate. So for those investor, preferred stock is a better option. But there are some disadvantages or cons of preferred stock. Paying dividend on preferred stock is an obligation regardless of company's profitability or business position. It is some sort of debt financing interest, and even in difficult times, company has an obligation to pay regular dividend on preferred stock as per the condition decided as certain percentage of par values of stock. The presence of preferred stock in a company or a business can make it more difficult for a company to raise additional finance by other means in the future, as preferred stock has a liability of regular dividend repayments. Preferred stock may have a limited potential for capital appreciation of stocks as compared to common stock. Common stock shareholders will definitely got regular capital appreciation of their stock holdings, whereas the same is not that common with preferred stock. Equity financing have several advantages over debt financing. The biggest advantage is that companies or business don't have to pay back the principal invested amount or money, as stockholder or investor in equity financing are not creditor but are part owner in a company or business. If unfortunately business enters into bankruptcy, then in that case stockholder or investor of equity financing lose its money along with the company. In equity financing, when there is no need to pay regular interest or part of principal as monthly payment of debt financing, so in equity financing there is often more cash flow in hand for operational expenses, and that provide a liberty and leverage in financial management. The investor of equity financing understand that it takes time to build a business, so company will get the needed money without the pressure of having to see product or business thriving within a short amount of time. Investor can maintain patience and business can smoothly grow to pay both dividend as well as appreciation in stock holdings. Equity financing also has some disadvantages. Equity financing involves giving up of ownership of a portion of company to stockholder or investor. The riskier the investment, the more of a stake the investor will want, and in that case the initial promoter of the company no longer solely can make final decision. In decision making, they have to consult their investor before they make any final decision, and if investor has more than 50% of company investment, then he can also become the boss of company and will take major decision of his own, and in that case initial promoter may lose their control on company. Venture capital is a different type of external financing. Venture capital refers to investment made by venture capital firms or investor in an early stage of a high growth potential company that may have a high risk but that also offer a possibility of substantial returns. The venture capitalist not only support the financial capital for business, but they also provide their expertise, mentorship, and their industrial and commercial connections to help company to grow and share profit with investors. Venture capital funding typically involve a process where entrepreneur having a new business startup idea, he pitch his idea in front of venture capital firms. If venture capital firms are interested in that business idea, then these firms will conduct due diligence, analyze and evaluate the business idea of entrepreneur and assess the company potential. If venture capital firm decides to invest, then they provide the required capital in exchange of an equity stake in the company. And after that investment, venture capital firm also support the company growth, and many a time venture capital firm also have a aim to exit the investment through methods such as IPOs or acquisitions. Grants and subsidies are non-repayable funds provided by government, other organization or some foundations to support specific projects or activities. These government initiatives may include low interest loans, grants or tax incentives. Now any business should explore relevant government resources to identify potential financing opportunities, and many a times grants and subsidies become most valuable source of financing for research and development, innovation ideas or some social initiatives. Grants and subsidies neither require repayment obligation nor it require the company to share its ownership or control of the business as it is in common stock shareholders case. However, the disadvantage is that the company may have to meet specific criteria to qualify for the grants. Now, receiving a grant or subsidy can boost a business reputation, credibility, and market position, and it will make it more attractive to customer, investor, and even other partners. These grants and subsidies are often highly competitive. Many businesses will compete for a limited pool of funding in terms of grants and subsidies. The application and selection process is very rigorous, and meeting all eligibility criteria may be a great challenge. Grant and subsidies typically comes with fulfillment of specific conditions and reporting obligations, and compliance of these requirements involve additional administrative tasks, documentation efforts and cost to the company. Applying for grants and subsidies can be a time consuming affair. It requires thorough research, detailed proposal preparations, significant effort and all type of supporting documentation. So it's a time consuming, rigorous, tough and challenging task to apply for grants and subsidies. Grants and subsidies also come with some restriction on how the funds can be utilized. So it limit the freedom of company in its operation. The business or company must adhere to specific purposes outlined in the funding agreement, and that limit flexibility and freedom of company in resource allocation. Relying solely on grants and subsidy as a source of finance can create a typical level of dependency. There is also a risk of funding cuts by government and organization. There may be changes in government policies and which may impact the availability or continuity of such support of grant and subsidies. So it is very important for any business to carefully evaluate the pros and cons of grants and subsidy in the context of their specific needs, goals, and the eligibility criteria before pursuing the source of finance as grant and subsidy. There are various types of grants and subsidies available for businesses. Some grants are for research and development work and funds provided by government and other organizations to support innovative research and development project of specific areas are given grants. There is a grant for small business promotion. These grants target small business organization to help them with startup cost or support their expansion or assist them in operational expenses. Now in this energy crisis era, there are grants for energy efficiency program, and these grants aim to encourage business to adopt energy efficient practices or technologies. Bureau of Energy Efficiency, Government of India have these energy efficiency grants. Government also offer grants for export promotion, and businesses looking to expand into international market got funds as grants and subsidy for export promotion. There is also grants for industry specific operation. Some specific sectors such as agriculture, advanced technology or healthcare got such grants and subsidies. Crowdfunding is altogether different, new, innovative source of funding. Crowdfunding involves raising small amount of capital from large number of individuals through online platforms. It enables business to access funds and gain public support simultaneously. It is also an expansion of reach beyond traditional source of external financing. It allows entrepreneurs, new startups, or even individuals to access capital from diverse group of supporter or investors. But crowdfunding platforms are highly competitive, and it is really a challenge to stand out among numerous other crowdfunding campaigners and get support and finance from crowd. Running a successful crowdfunding campaign requires significant time, effort, and marketing skill to attract and engage potential supporters and financiers. It is also very challenging to meet the obligation and provide reward or returns to crowdfunding supporters, and meeting these requirements and providing deliveries as supported need become a very complex and time consuming task. We have discussed sources of internal financing like a retained earning or depreciation of fixed asset in our first learning video, and in the same video we have also discussed external financing by debt financing and trade credits. And in this video you have learned about equity financing and understood both common stock as well as preferred stock. We have also discussed financing by venture capital funding, fund collection by crowdfunding, and financing by government or charitable organization programs as grants and subsidy. We have discussed pros and cons of all type of financing. Overall, the choice of means of financing depends on various factors that include size and complexity of our project, the internal financial resources of the company, and the terms and condition of external financing means option available to us. It is essential to evaluate each financing option carefully and to choose the one that best meets the requirement of our project while minimizing the financial risk of the company. Careful evaluation and appropriate selection of financing source will contribute the success and growth of our business. We hope you found this informative learning video useful. Our other learning video of the same playlist are equally helpful. You can use them in your studies or share them with your friends. And if you need exam centric dedicated notes, do join membership of our YouTube channel Shridevi Classes. Happy learning. Have nice time. Thank you very much.